Good morning, folks. Andrew Schartenberg here, your neighborhood mortgage engineer. Today is Tuesday, February 8th, and I'm here with your rate report and homebuyer tip of the day. So today, rates are largely unchanged from where they were yesterday. We're at 5% on conventional mortgages, Fannie Mae and Freddie Mac, 30-year fixed rates, 0-point perfect scenario loans. And on FHA and VA government loans, we're at 4.75%, again, for the 30-year fixed, 0-point perfect scenario loans. The 10-year Treasury note yield is at 3.66% right now, so largely unchanged from yesterday and from this higher range that we've been at lately. The stock and the bond markets are relatively flat today. The Dow is up about 30 points, and the bond market really has only changed by about 0.01 percentage points today. And basically, what I have to say about that is that the longer that the 10-year Treasury note stays above the 3.5% mark, the more of a chance we have for rates to stay high and possibly go higher. So hopefully we're going to see some relief here and some negative economic news, which will in turn hopefully put some downward pressure on rates. That's the rate discussion today. So your home buyer tip of the day. This is somewhat not very timely. Mainly because the interest rate that the Fed controls is very low, and it really hasn't changed in a while. But I wanted to debunk a common myth for you folks out there today. A lot of people think that the Federal Reserve controls mortgage rates. That is not true. What the Federal Reserve controls is monetary policy, and this is an economic term. We're not going to get too detailed into the discussion because I know a lot of you folks just don't probably care about that. But what they control is the monetary policy, which is the federal funds rate, which is the interest rate that banks borrow money from the Fed overnight to satisfy their capital requirements on a daily basis. And they also control the discount rate, which is the rate that banks charge each other to keep their balance sheets shored up overnight. So those two things affect the prime rate. So when you walk into your bank, when you get a car loan, you'll see the prime rate out there. And that's what's controlled mainly by the Fed. So the prime rate is going to be anything that you're charged on home equity line of credit, any kind of line of credit at your bank, credit cards, car loans, that kind of a thing, not mortgage rates. Basically, what happens with mortgage rates are mortgages are a bond. They're packaged up once they're originated, and they're sold in the format of a bond on the secondary mortgage market. And what happens there is every bond has a yield. So for you investors out there, you'll know that when you buy a bond, it's going to pay you a certain dividend over the life of the bond, and that's called the yield. So what happens is the lower the price of the bond, the greater the yield. Now, when there isn't a lot of demand for bonds, that obviously drives the price down and thus the yield up. Mortgages or mortgage-backed securities run very closely with 10-year Treasury notes, which is a government debt. And it's probably the best indicator of a comparable investment. So that's why we're always looking at the yield on the 10-year Treasury note as an indicator of where mortgage rates will be. So the bottom line is, if you see 10-year Treasury notes, if you see the yield on those going up, it means it's a signal that mortgage rates will very likely go up as well. And that is what we look at, and that's where economic data comes into play, because bond traders look at that kind of stuff, and they either move their money into the bond market, thus creating higher demand and a lower yield, or they move their money out of the bond market and into other investments, creating a lower coupon price for the bond, be it a 10-year Treasury note or a mortgage-backed security, and thus a higher yield and higher mortgage rates. So that's kind of a basic primer on mortgage rates, and the Fed really does not control them, guys. It's the trading in the bond market, just like oil traders control the price of your gasoline. Same kind of thing there. So that is it. If you have questions on that, I can get into a detailed discussion with you anytime. and my contact info is at the end of this. We'll see you tomorrow with the rate report and home buyer tip of the day. Everyone be good out there.